Good morning, everyone. I'd like to welcome you to the Accounting and Auditing Update. Hopefully everyone can hear me clearly. I just wanted to start off with a few administrative items. Obviously, as you're reviewing the webinar, the PowerPoint presentation is available on your screen. Our office will also be emailing you a copy of the presentation. Just also to ensure that I address any questions, please note that there on your screen should be a hand or an ability to raise your hand and or type questions. And so hopefully you see that, and feel free to pose any questions along the way, and I will try to make sure that I answer all applicable questions. If even after the presentation you have further questions, certainly feel free to email me, and at the end of the presentation I will make sure that everyone has my email address. But again, if there are other questions that you have either during the presentation that you may want to pose after, and or if there are any thoughts that you have after today's webinar, certainly again feel free to either email me and or call me at the office. So today's Accounting and Auditing Update, we're going to be covering several topics. Today's key points will involve going over the new uniform guidance, what's now being known as the single audit, previously known as the A133, which was in reference to the circular that was related to the performance of that type of work. Now that circular no longer exists, it's now known as the uniform guidance or single audit. The second item that we'll be going over today will be proposed changes to the not-for-profit financial statement reporting model. Again, this has been something that's been talked about in a previous seminar, but I sort of want to update everybody on where that still stands, talk a little bit about the benefits that people are finding with perhaps that reporting model being instituted, and just to get that on your mind in terms of your own organizations and how that change might be beneficial. Then the last section is the increased focus on not-for-profit financial viability. As we go through some of the new uniform guidance rules, there's now an obligation to look at the financial health or the financial sustainability of organizations. And so I would imagine that not only in the government arena, but we're also going to see more in the private arena, where focusing on the sustainability or the health of an organization is going to become particularly important. So the new uniform guidance, or also known as the single audit, the actual title here on the screen is the Uniform Administrative Requirements, Cost Principles, and Audit Requirements for Federal Awards, and it's located in section Title 2 of the CFR, which stands for the Code of Federal Regulations, in Part 200. So you can see there that I've given you the actual location. This is in the Federal Registrar. So if any of you, again, we have copies here of what that reads, of that particular section of the Code of Federal Regulations. I'd be more than happy to send that section to anyone after today's presentation. But again, if you were to type in 2 CFR Part 200 in the internet, it will also come up and be available for your read. But that's the technical name of the guidance, the full name of the guidance, but most of us out in the profession are just commonly referring to it as the uniform guidance. The effective dates of the new uniform guidance for non-federal entities, which again are synonymous with not-for-profit organizations and or any non-federal office, which also applies to, again, institutions of higher education or colleges and universities, and also state and local departments. It will need to be implemented, particularly the administrative requirements and the cost principle requirements, are required to be implemented for awards received after December 26, 2014, and for any additional or incremental funding to existing awards made after that date. So I want to go back and be very clear about this part of the new uniform guidance. There's 3 sections to the uniform guidance. There's administrative requirements, which for most of you, if you remember, this used to be Circular A110 for nonprofits. Then there's the cost principles section, which used to be circular A122 for nonprofits. And then there's the audit requirements, which again used to be A133. So there were 3 different circulars that governed those 3 different areas of the single audit. The administrative requirements and the cost principle requirements are the 2 sections of the uniform guidance that are applicable to awards received after 12/26/14. So just as an example, some of you out there may have foster care programs. Foster care awards or the foster care contracts typically run from July 1, 2014, if you are a junior in, to June 30, 2015, let's say. That particular contract then has an award date of July 1, 14. So in effect, that award was made before December 26, 2014. For some other clients we have that have perhaps early head start, some of those contracts re-upped, if you will, in April. So their old contract ended on March 31st of 2015, and they received a new contract on April 1 of 2015. In effect, that award, which again was made after December 26, 14, would be subject to the new uniform guidance. So what we are doing and what clients need to be aware of and what we as auditors are aware of is you may have contracts or awards that fall under 2 different sets of guidance. If they were made before 12/26/14, they follow the old, what we call A133 or A110 and A122 in this case, if it's the administrative and the cost principles, they follow the old guidance. If the awards were made subsequent to 12/26/14, then they are subject to the new administrative and cost principle guidance under the new uniform guidance. So in effect, as the auditors, we could be looking at 2 different sets of regulations that govern the contracts that you have, particularly in this transition year. The second bullet point on the screen talks about the audit requirements. And the audit requirements are effective for fiscal years beginning. You see that's highlighted, that's bolded rather, beginning on or after 12/26/14, and there's no early implementation in that regard. So if you notice the word beginning, that means for any fiscal years beginning after that date. So that would only be for December year-end clients, that would be their fiscal year 1/1/15 through 12/31/15. So the current December year-end clients would have to follow, in terms of the audit requirements, that for their audit of their fiscal year into 12/31/15, and for the June year-end clients, those audit requirements would be effective for the June 30/16 year-end, as your fiscal year, which begins after that 12/26/14 date, would be your July 1/15 fiscal year. So again, the administrative requirements and the cost principle requirements are in effect immediately, again, for any awards received after that date, and the audit requirements go into effect for the full fiscal year, which begins after that date. And this is sort of re-explaining that again, looking at it from the year end. So right now, the administrative and cost principle requirements under the uniform guidance are currently applicable to the year ends March 31, 2015, June 30, 2015, and please excuse the typo, that should be September 30th of 2015. Those year ends currently right now should be following the administrative cost and cost principle guidance under the new uniform guidance. Because again, these would be for awards and these would be for contracts that you have received already in these fiscal year ends that were made after 12/26/2014. The second part here for the 12/31/15 year end, all of the components of the new uniform guidance are now in effect. It would be the administrative, the cost principle, and the audit requirements. And because again, what happened is if you were December 31st, 2014 year end, so just your year end last year, because this went into effect on 12/26, the likelihood that you received an award in the last 4 to 5 days of your fiscal year that would have been subject to that new guidance was slim to none, because most clients are not getting awards in the last 5 days of their fiscal year. So that's why December 31st, 2014 would not have been applicable to, in most cases, would not have been applicable to the administrative and cost principle guidance. Now in 2015, the December 31 year ends would. So again, just to be clear, the administrative and cost principle guidance, you should look at the award dates. And for the audit requirements, those are based on your fiscal years beginning after that date. Determination of applicability to old guidance versus new guidance, again, just reemphasizing that the federal awards, it's dictated by the award date, not when you receive the funding. So if you think about this, under some awards, you could have a contract award, and oftentimes it's dated, again, let's say it's dated January 1st of 2015. It technically would be subject to the new guidance because that is the award date. Now, in another case, perhaps you receive an award that's dated August 31st of 2014. That would not be subject to the uniform guidance because, again, that's before December 26th. Even if perhaps you receive the funds subject to the, after the beginning of the year. So maybe you got the contract actually signed and it has a contract date of August, but perhaps you don't get the funding until January 1 of 15. It's not when it's receipt of the funds, it's actually based on the date that the date of the award. And then as it relates to incremental funding, and I want to define that for a moment. Incremental or additional funding relates to grants that you already have or contracts that you already have in existence that may be augmented. So perhaps you have an early Head Start contract already in existence that perhaps, I'm going to use this as an example, perhaps was dated September 1st of 2014. Well, if it's dated September 1st of 2014, it's obviously before the new guidance is in effect. But perhaps at January 1, 15, you get additional money added to that contract. The fact that that additional money is added at 1/1/15, you probably get a contract amendment that is dated as such. So what we then in that case, or you as the client in that case, have to determine is what applies to that additional funding. And so here in the guidance, there was a lot of questions about that, about how do you determine whether it's subject to the existing award requirements, which would have put it in the quote-unquote old rules, or whether because it was received on January 1, it's subject to the new rules. Well, here in this note in the second bullet, it states that the uniform guidance applies only to funding increments, so additional funding to existing awards where the federal agency considers the funding increment to be an opportunity to modify the terms or the conditions. So if that new funding gives you new deliverables, if it means that they modify the existing terms of the award, then that is considered, that portion of the award will be considered to be subject to the new guidance. So again, you can even have parts of awards in effect. Your September 1 contract that you originally had was subject to the old guidance, and the additional funding that was received is subject to the new guidance. In certain cases we have where clients do receive maybe extensions of time to perform the contract. In that case, that would not be deemed new deliverables. They're just giving you additional time. Perhaps you hadn't used all the original funding, and so the contract term has been extended. That is not considered new terms or new conditions. Typically, there has to be new deliverables. There has to be an expansion of performance of service. There has to be something in that arena that would make it be subject to the new guidance. If it's just an extension of time or just an additional funds under the same terms and conditions, then again, it would be subject to the old guidance. The important thing about these two bullets is that this determination is the responsibility of the client. So ideally, what needs to happen is, particularly if you're in a year about to be subject to audit, as we are coming out to clients, we need to be able to sit down with the client and go through the contracts that they believe will be subject to old rules and subject to new rules, again, based on award dates or again, based on incremental funding dates. So it's important that that work is done on the front end to determine, because that impacts how we test those particular contract awards, whether we're testing again under old guidance or testing under new guidance. So in this year, when we're doing for the current year ends that are ended June 30th, 15, there may be some contracts that we have to test under old regulations, which require us to document it a certain way, and then other contracts that require us to do it under the new uniform guidance, which again has certain different complexities in the compliance testing. Again, this is re-emphasizing again that it is the entity's responsibility to review the awards that you have, both for current and multi-year, because again, sometimes you have multi-year awards that may be granted obviously 2 or 3 years ago, and this is the 3rd year of an existing award. In that case, again, it's possibly that the possibility is that it's just subject to old rules because the award was granted some years ago, which was before these requirements. And then the other thing I want to emphasize here in this bullet is that this applies both to your analysis of your own awards, but also any sub-awards that you may grant out. Because I know under some of your current contracts, you have sub-recipients that are performing certain portions of the contract for your organizations. So this applicability has to be determined both at your level and then in your application to your sub-recipients, because that also, the new guidance has some a broader, actually a more expanded, I should say, requirement as it relates to sub-recipient monitoring. So again, if you've given awards or sub-awards to sub-recipients that were dated after that 12/26/14 date, those sub-awards will be under the new guidance, and then again has an expanded sub-recipient monitoring compliance component to it. So you just want to make sure again that you're doing it not only at your level as the pass-through entity, particularly maybe to the state or the Fed, but you're also doing it to those that you are passing dollars on to as well. Now, the new uniform guidance is broken out to several subparts. Here I've identified the subparts that and their and what's contained in those sections. So Subpart A has the acronyms and definitions. And so a lot of what's in that section, obviously, as federal awards, there are a lot of acronyms that are utilized. There are a lot of common words that are utilized. Things like, what does it mean to be a subcontractor or a subrecipient, I should say. Certain acronyms that are used constantly in reference to federal awards. So there's where all the definitions and acronyms are laid out for your education. The Subpart B, general provisions. In that area, a lot of what in that is sort of going back to A110. A lot of the general administrative provisions are contained in Subpart B, again, applicable to all organizations. And again, just to reemphasize, the new uniform guidance is sort of the collaborative bringing together of multiple circulars that existed. There were certain circulars that were for federal awards, and those circulars were specifically for colleges and universities. There were circulars that were in existence for state and local government, and then there were circulars that were in existence for you as nonprofit organizations. And some of those circulars actually were in conflict with each other in terms of some of the administrative requirements and some of the audit requirements. And so in an effort to sort of minimize the burden and minimize the conflict between some of the circulars, all of those circulars have now been collapsed into what we call one uniform guidance. And so obviously state and locals, colleges and universities, and nonprofits can now use one set of guidance to be administered over their contracts. So then going back to the subparts, then there's Subpart C, pre-federal award requirements and contents of federal awards. What now is in that subpart has to do, there's a lot of information on what must be contained in an award. And again, remember, many of you as nonprofit organizations are recipients of awards, either pass-through awards from state and local entities, and in some cases you're recipients of direct federal awards. What the requirements are now is that those awards must have specific information contained on the face of and in the body of those awards. Things like the CFDA number, the requirements under the contracts, the term of the contract, again, identifying if there's federal source dollars. Oftentimes, some of that information previously had not been contained in the award agreements. For many of you who know out there, we as the auditors sometimes ask you to let us know what the CFDA number is that governs the source of money. And oftentimes you would go back to the contract and you wouldn't be able to tell because there was no indication of what was no indication of the particular federal source of funding that was indicated in the award agreement. So now there's a requirement for the award agreement to contain certain components. And this is true also for you as a nonprofit organization if you're passing through dollars to subrecipients. Subrecipients, you as the pass-through agency are also required to put that same information in the sub-awardee agreements that you make with those organizations. So again, the government is required to put it in your award agreement, and you, particularly as a pass-through entity, the other sub-recipients are required to make sure that certain information is contained in the agreement as well. That in this section, it also talks about, which will be a later topic, but it also talks about assessing the health and the financial viability of organizations which you are funding. That is now sort of a requirement under the new uniform guidance. And I would suspect that that has come about because there have been several nonprofits that have closed doors, that have misused and mismanaged funding. And so now there's a bigger emphasis on continuing to fund such organizations or even getting into collaborative arrangements with such organizations. And so as a nonprofit organization, you should be thinking about, and this is getting into the subrecipient monitoring, you need to, there's expanded due diligence that you have to perform related to those organizations. And that due diligence needs to be performed on the front end before you think about contracting with those organizations. And I'll talk a little bit later in the presentation about what that role is, what the monitoring looks like, and what that evaluation and a risk assessment sort of looks like on the front end in order for you to determine whether you should be passing dollars through to those organizations. And you will be held accountable if there is misuse, and you will have to prove what you were doing on an annual basis to perform that risk assessment to make sure why you thought that organization was appropriate to pass through dollars to. And then again, the government is having to do those same things in passing dollars through to you as a not-for-profit organization. So there's a lot of new requirements in that area in terms of pre-federal awards, meaning more assessment on whether the organization should be receiving dollars either from the government or from you in terms of pass-through dollars. The post-federal section, Subpart D, has to do with it streamlines a lot of the closeout process. It's also in that section that there's a lot of conversation about systems and processes, about cash payment settlements. So a lot of what's in that section is mostly related to the ongoing nature of awards and the closeout of the awards, either again with your subrecipients or with the governmental office that you've received the funding from. Subpart E is where the cost principles are located. Again, this is synonymous with the old circular A122. In that section, there's going to be a lot of discussion about allowability of costs, treatment of costs, and so that's again similar to what was previously circular A122. And then in Subpart F are the audit requirements. Again, Subpart F is probably more critical to us as the auditors, but in understanding what the auditors will be required to do and understanding what we have to perform and coming out there and being prepared for that, I would encourage all of you to read that subpart as well to understand what the changes that have been implemented in the new audit requirements, and then how that may impact you as an organization in terms of our approach to your audits, in terms of the selection of certain contracts. That's all contained in Subpart F. Then there's numerous appendices that are contained in the uniform guidance. The first appendix, notice of funding opportunity. That again is the appendices 1 and the Appendix 1 and Appendix 2 pretty much deals exclusively with a lot of the contract provisions. I spoke earlier about the fact that there had to be specific language contained now in awards that you receive both from the government and in awards that you then give to other subrecipients. Well, it's in those two appendices that that information is addressed. It talks about if there are changes in any of the expectations of the funding, how frequently that has to, and how in what time frame that has to be made aware to the recipient of the grant. And again, what specific information has to be contained in any notices of funding that are given to both you, the nonprofit, and again, subrecipients. Appendix 3, and you can see Appendix 3, 4, and 5 on this page relate specifically to cost identification and to certain cost allocation methodologies. Although this is now uniform guidance, meaning everyone, both state and local, both institutes of higher education, colleges and universities, and nonprofits will be following this uniform guidance, there is still some recognition that these entities operate very differently. And so it's in these these various appendix sections that they're addressing some things that are specific to those types of entities. So in Appendix 3, there's a conversation about indirect costs and how those should be handled for institutes of higher education. In Appendix 4, indirect costs are discussed for nonprofit organizations. And then starting in Appendix 5, state and local government and Indian tribes, that also talks about their central cost allocation plans. And then beyond that, there's also further appendices here, and you can see Appendix 6 is dealing with public assistance type cost allocation plans. The state and local government in Appendix 7, state and local governments, their indirect cost proposals are addressed in that section. And then in Section 8, nonprofit exempt, it identifies which nonprofit organizations are exempt from certain cost principles, and those are just specific types of nonprofit organizations. And then it goes on in Appendix 8, in Appendix 9, 10, and 11 to discuss hospitals, which have, again, specific cost principles related to those types of entities. 10 discusses the data collection form. As recipients of federal funding, many of you know that a data collection form is required to be uploaded to the Federal Audit Clearinghouse at the end of an audit. That data collection form is going to be amended, is going to be changed, given the new regulatory requirements under uniform guidance. So it's in that appendix that they're discussing some of the changes that will be implemented. And then in Appendix 11, it's the compliance supplement. And this particularly is more important to us as the auditors. The compliance supplements have been devised to give us guidance on how to audit specific federal programs. That is also, the compliance supplement is also used by state and local agencies and you as nonprofits, again, to read through and understand some of what we'll be looking at when we're auditing those programs. And the compliance supplements are arranged by the CFDA number. So again, you want to look at whatever particular funding you receive and whatever the particular CFDA number is. Those are in alpha order, and so you can go to a specific supplement that might cover funding that you're receiving. So again, the key changes, and I talked about this already, is that this uniform guidance is consolidating and establishing administrative requirements, cost principles, and audit requirements for federal awards for all non-federal entities. So again, as long as that means state and local, that means not-for-profit, and that means colleges and universities. The guidance is also providing, the newer guidance is also digging into the areas of salary and wages. Then it's providing information for federal agencies to approve alternative methods for accounting for salary and wages based on achievement and performance outcomes. And we'll talk about that a little later. As many of you know, in the old A122 guidance, it was very specific on how salary and wages had to be documented. The specific language talked about after the fact accounting of people's time. So it pretty much alluded to the fact that people had to have timesheets, after the fact timesheets to support their hours, and that those timesheets had to be maintained based on the frequency of when payroll was processed. So if you were paid every 2 weeks, then you should have timesheets that would reflect 2 weeks worth of work. And so it's in this new guidance that there's been some relaxing of that. Unfortunately, it's not as direct and straightforward as it should be about what some of the alternative methods are, but it does talk about the fact that certain federal agencies, and again, it's with prior approval, could alter that or could approve the ability to use alternative methods for tracking salaries and wages. And then the third bullet point, which is really has become really important, related to the uniform guidance, relates to this sort of de minimis 10% as it relates to indirect costs. Many of the organizations out there that receive substantial federal funding or substantial direct federal funding have applied for indirect cost rates. And some of your funding agreements require that you apply for indirect cost rates. So for those of you that have indirect cost rates, that is going to be used by your organization, and it's under this new guidance that it says all federal departments should adhere to utilizing a cost rate that you've received from another federal department. For those organizations out there that do not have a federal indirect cost rate, there will be the acceptance of this 10% de minimis. And basically what this is stating is that the government is recognizing that there's a certain amount of administrative work that goes into managing all nonprofits, that goes into managing contracts. And so the de minimis, sort of without any proof, that's going to be allowed to be reimbursed for under many of these contracts is going to be this 10%. Now the calculation of that 10%, you can see that it says MTDC, again another acronym, that's modified total direct cost. So it's not 10% of all cost, it's 10% of specific costs. And so I'll talk a little bit about what modified total direct costs are in a later slide. But again, it's basically stating that it's going to allow the not-for-profit to claim basically a flat 10% under certain contracts. Now, for those of you whose indirect cost rates are actually higher than that, it may be beneficial then for you to apply for federal indirect cost rates. For those of you where it's less, well, then you're getting the ability to claim more than that as a flat rate. And again, the only caveat here is for those organizations that already have a federal indirect cost rate, you have to stay with that. You cannot vacillate between the two. Once you have a federal indirect cost rate, that then becomes the rate that you must use. You cannot then return to this sort of claiming of the de minimis. And for those of you who have an indirect cost rate, a federal indirect cost rate that perhaps is below the 10%, you cannot then decide and not then start using the de minimis 10% because it gives you the ability to claim more if your federal approved rate is actually less. So it's just one of those things where, again, I think in most cases there's going to be a push to get federal indirect cost rates, but there's also a recognition that for some of the smaller nonprofits, that may be more of a burden to be preparing those indirect cost rate proposals on a frequent basis, so they'll be allowed to just claim a de minimis 10%. The new uniform guidance, some of the changes from the old guidance is there has been a raising in the threshold of the requirement for a single audit, and then a raising in the threshold of what is considered to be a major program. So if most of you remember, under the old guidance, under the old audit requirements, an organization that received more than $500,000 in federal funding, whether it was passed through or direct, had to have a single audit. That threshold has now been raised to $750,000. So for many of you out there, you're receiving well in excess of that, so that doesn't change your need for a single audit. For some clients who were, we have a few clients who were teetering on that threshold. They maybe 1 year had about $450,000 in federal funding. I want to be clear on that. It's not total funding, but it's federal funding. And then in other years, they might have $500,000. So in certain years, they were getting a single audit. And then depending on their contracts in another given year, they might not have been having one. So now that threshold has been raised to $750,000 of federal funding. The other threshold that was raised was related to major program determination. So we as auditors are required, when we come into any of your organizations, we are required to look at the various contracts that you have that are subject to the single audit. Basically, what we do is we are required to divide them into two sort of buckets, if you will. We call them Type A programs and Type B programs. A Type A program, by its definition, used to be any federal program where the client expended more than $300,000 in federal funding. So if there were more than $300,000 in federal expenditures under a contract award, it was a Type A. And if it was under $300,000 of federal funding in that particular contract, it was a Type B. Well, this new threshold now of $750,000 is not only being applied to be the single audit threshold, meaning whether you require a single audit, but that same number is also being used to define the Type A and Type B programs. So now a program that expends more, 750 or more, is the Type A, and 750 or less is the Type B. The reason that is important is because Type A programs, typically as auditors, are the ones that have to be focused on more. So when you think about you think about us coming to your organizations as not-for-profits, and maybe you have 5 or 6 contracts. Under the old guidance, contracts that maybe had about $350,000 were considered Type A, and they were the part of the contracts that we had to always audit in a 3-year rotation. Now, with the threshold being raised to $750,000, that same $350,000 contract now may not be selected for review by us. The threshold has been raised, and so that $350,000 contract may no longer be in our purview anymore, depending on, again, a risk assessment that we also do of that contract. So for some clients, there may be less contracts and awards that are audited under the new raising of the threshold. But again, I always give the caveat that there's also, the threshold is one component, but then there's also our assessment of risk related to those contracts. So for example, I'll use mental health as a type of contract. Mental health contracts tend to be complex in how they're settled, how they're managed, in terms of them being part fee for service. They have an interim rate and then their cost settled. We still have to look at the complexities of the contracts. And if we deem those contracts to be higher in risk, either because they're new to your organization, that could also be a reason why they're high risk. That could also be that the person that manages that particular contract is new to your organization, so they haven't had a lot of history in managing the funds. That could be another reason for a potential risk. We still have to do a risk assessment, and if we think that a contract, though under $750,000, has a high risk, we can still then choose it. That's at our auditor's discretion. So I want to just be clear that just because it's under 750 doesn't mean that we won't look at it. There's still a risk assessment involved. But for some clients, it could turn out that we're actually auditing less. We're doing less federal compliance testing on certain programs. In terms of the overall financial audit, we're still needing to get comfortable about the amounts that have been earned under those contracts. But in terms of the compliance testing that is required under the federal awards, there may be less compliance testing in certain areas for certain contracts that certain clients have. The second bullet, the change, is that it prohibits federal awarding agencies from imposing inconsistent requirements. So again, the uniform guidance is intended to be the overarching requirement for all federal agencies. So what this is saying is that Department of Health and Human Services can't require one thing and then in their contracts, and then you get a contract from Department of Education and they require something completely different. That all of these federal agencies are supposed to be using the same guidance and asking for the same from those that they fund in terms of consistency, because oftentimes One department may have stated that they wanted something treated a certain way, and another department, federal department, might have stated that they wanted something in their audit in their award treated another way. And in terms of the nonprofit organization, that can really create an administrative burden to not be able to apply one overarching methodology to in terms of compliance to your contract. Expands pre and post award requirements. Here is where I talked about that the pre and post awards now involve more risk assessment in terms of financial viability, both at the state and local level in terms of granting to your organizations, and then also at your organization level in terms of granting to subrecipients. And then there's expanded pass-through entity monitoring of subrecipients. And then there's even been expanded requirements as it relates to procurement. So all of the expansion of those compliance requirements are contained in the post-award, the pre and post-award areas. And then just the last bullet, the whole point of the uniform guidance is also to try to contain more clear and more extensive definitions for organizations to be able to clearly define in terms of should, must, in terms of what's required of your organizations, having cleaner and clearer language in those areas. So an organization can really understand what they're required to do or something more suggestive in nature. Subpart D, I talked about earlier on that Subpart A was the acronyms, Subpart B was contract provisions, Subpart C was the pre-award provisions. Well, Subpart D is the post-federal award requirements, and this is a key area, which is why I've sort of expanded looking at this particular subpart of the uniform guidance. So what's contained in Subpart D, you can see, is from financial management. So financial management mostly relating to your accounting systems. You can see the Subpart D talks about your internal controls. It talks about payments, which in most cases is management of the receipt of payments, particularly if you're in direct federal awards that are having drawdowns. Here is in this section, cost sharing and matching is covered. Program income and how that has to be treated. Procurement standards, and particularly in that area, that's again an area that's been expanded. What it means, what the thresholds are, what now has to be done is related to certain contracts. Performance and financial monitoring and reporting under your federal awards are contained in this section. Subrecipient monitoring, which again I stated is an area that's expanded in this new guidance. And then remedies for non-compliance, which is again directly related to the bullet point above it in terms of if you are finding areas of non-compliance, what are the remedies that you should be seeking. And then the last bullet point in this area is closeout, closing out contracts, when the closeout and how and the timing of when the closeout must occur. All of that's covered in the Subpart D section. So I'm going to talk now about a couple of the going a little deeper into some of these sections that are contained in Subpart D. The definition, when they talk about financial management system, it's in the uniform guidance that the financial management system must include identifications in all accounts, all federal awards received and expended, and that the federal awards, the federal programs under which they were received, that you must know the CFDA, you must know the award number, the year, and the awarding agency. So again, what this really is alluding to is that your accounting system has to have the ability to segment awards. Ideally, you should not be tracking all of your federal awards in one cost center, that you should have cost centers that break out how much was earned under a federal award, how much was expended under the federal award. Ideally, you should be able to look in that cost center and know what the matching dollars were. If the matching dollars are being made by in-kind matching, then ideally in that cost center you should be able to identify if you value the in-kind, I should be able to sort of print a P&L for that contract and see how much was recorded as in-kind in that cost center. If you're doing it with actual cash donations or cash dollars, or maybe matching it with other types of contributions, perhaps you had a grant from the Amundsen Foundation that, or something to that effect, that was used as a match, then I should also be able to see it in that cost center. So it just talks about identifying in accounts the amount of federal award that was earned, expended, and then Not necessarily in your accounting system do you have to have the CFDA number or the award number, but that is something that certainly should be maintained in a binder or folder in terms of having the reports, having the award contract handy and available within your accounting department. The one thing that I will caveat about the award number and the award year, because this comes up often in our audits, is that sometimes you receive awards that do not mirror your fiscal year. So perhaps you have an award that goes, if you're a June 30 year-end client, you may have an award that goes from April 1 to March 30. And then so in that case, in your fiscal year, you may have 2 awards that actually make up your fiscal year. And for certain clients, those are being tracked all in one cost center. In terms of what I'm stating here is that the award, for an example, say we're talking about your 6/30/15 year. Well, if you had an award that went from 4/1/14 to 4/1/14 to 3/31/15, and then you got a new award on 4/1/15, and that went to 3/31/16. In your fiscal year, then you've got 2 different awards that actually have 2 separate award numbers. From the standpoint of your financial tracking system, you need to be able to determine how much was earned under the old award that ended at 3/31/15, and how much was then earned on the short period of the second award that was earned between 4/1/15 and your fiscal year in 6/30/15. So ideally, those should be being tracked in separate accounts. And oftentimes this is really important because on the schedule of federal awards, we are required to put the award number. So it's not just that it shares the same CFDA, so it can be reported as one full number. It has to be reported by the award number and the contract year, which again can be made up of 2 concurrent contracts that are in your fiscal year. So it's just important that your accounting system has the capability to do that. The one comment that I made yesterday in the live seminar was for many of you, for many of the clients you have fairly robust accounting systems. You're using Blackbaud, you're using MAS 90, you're using other systems that give you the capability of slicing and dicing your information by your cost centers and down into even some sub-awards. For others of you out there who may, depending on your size, may be using like QuickBooks, it's important to note that in QuickBooks, it has to be set up in the front end. QuickBooks can be used, but it has to be set up appropriately with the use of classes in a very defined manner in order to be able to achieve the same end result as a more sophisticated software. So I just encourage you, particularly from a reporting standpoint for those clients that are utilizing QuickBooks, to make sure again that you have that type of capability in the design of or in the use of QuickBooks in your particular organization. So again, that you're utilizing classes, and particularly sometimes you have multiple classes adding up to make one award. And I would talk about that could be a way that you can do the same for 2 awards, again, that span different contract years but are involved in your fiscal year. That might also be a way that you're able to track them by the classes but then total them into one award in terms of the program. So again, it's just important that your accounting software have that capability in order to begin to be consistent with the second bullet here, which is that you have accurate, current, and complete disclosure of the financial results of each of your awards. And so again, the better designed your accounting system, the easier that will be. Ideally, for most clients, you shouldn't have to do a lot of off balance sheet or off accounting system reconciliation to get to your numbers. Ideally, when you have to be at a place of maintaining a lot of things through Excel schedules, there's more room for error because it's not coming directly from your accounting system, and there can always be a transposition of information that's typed into an Excel schedule. So the more that you can get from your actual accounting system in terms of being able to report, the better off you are. Again, your accounting systems, and this is still, again, information that's contained in Subpart D, the records should identify the source of the federally funded activities. You should have effective control over and accountability for all the funds, and even for the property that's related to those funds. Under most federal contracts, if you're buying property under those awards, you have to tag them and be able to maintain a listing of where they're located. Again, because ultimately, if it's property purchased with federal dollars, that is property of the federal award, and in some cases may need to be returned to the federal awarding agency at the end of a program. You should have the ability within your financial management system to compare the expenditures that you have under your program with the budgeted amounts for each of the federal awards. Now, I know in most cases, most of our clients are not entering the budgets specifically into their software for all of their contracts. They may have a program budget that is agency related, but they may not have the contract budget directly in their software. The point of this being that for most of you, though, you do have to do reports to those funding sources. So there just should be a mechanism where you're able to compare your your expenditures per your general ledger to the budgeted amounts per the contract. And then the last bullet here, which is important, is written procedures for cash management and the determination of the allowabilities of cost. Particularly with cash management, which relates to drawdowns of direct federal awards. Under those awards, you are allowed to cash advance, so to speak, and there has to be very specific procedures written down as to how you will manage the cash. That cash, typically right after drawdown, has to be expended within several days. And so most of the clients that I have tend to not do at cash advances because it's a very slippery slope area that can get you in trouble in terms of if you don't have really well-written procedures for cash management on the federal award drawdowns. So most of the clients out there are in a place of cost reimbursement, which means they spend first and then request funds for reimbursement. So that tends to be the way that most of the clients want to go in order to ensure that they're spending it in a timely manner. The other written procedure that should be is for allowability. Oftentimes, the contract is very clear about what is allowable under its contract, but that information should be communicated to people working in the program, to people working in your accounting department, to make sure that non-allowable costs, things like fundraising, maybe staff parties, if those things are not covered by the contract, you want to make sure, A, that they're identified in your GL in a place where they do not then become rolled up into reports that then make their way into reporting to the funders. So again, I would always encourage that such non-allowable costs sort of have their own cost center code, if you will, so that it's clear if I'm a person in the accounting department or even in the program department, that I'm able to look at a report, a P&L, and identify the cost that should not be charged through to my program. It doesn't mean that they still shouldn't be in the cost center, because they are truly a cost of the program, but they need to be identified in a way that when you are reporting to the funder, that when you are doing your indirect cost pools, that those non-allowable costs are not making it into those reporting mechanisms, particularly for reimbursement. In terms of internal controls, the uniform guidance dictates that the non-federal entity must establish and maintain effective internal controls over federal awards that provide a reasonable assurance that the entity is managing the awards in compliance with statutes, regulations, and the terms and conditions of the awards. The one caveat I want to make in this area is that, and it's sort of here on this next slide, is that uniform guidance stated that the internal controls should, I bolded that, should be in compliance with the Green Book and COSO. The Green Book is put out by the Government Accountability Office. It's actually its title is the Standards, I think, of Internal Controls for Federal Agencies. So the Green Book actually is an internal controls manual that is used by federal agencies. But because oftentimes nonprofits, governmental agencies, colleges and universities all operate in a way that's very similar, this Green Book can be used as guidance in terms of system design for not-for-profit organizations, even though it was intended to be for federal offices. And then the COSO framework, and COSO stands for the Council on Sponsoring Organizations. Some time ago, the Treadway Commission, in terms of this COSO, developed what they call an internal control framework. There's been some recent updates to that framework, but that can also be guidance for design of internal controls. Now, the reason I point out the word should, because those two reference materials are just there for guidance. In some organizations that have the layers and the people to be able to institute some of those things that are recommended in those two pieces of guidance, that's great. For others of you out there that are smaller nonprofits, perhaps you don't have that layering. So I would encourage you maybe to read through, to look at those, and then decide what you can implement in your organizations in order that the internal controls are effective. Oftentimes in smaller environments, in the clients that we've worked with, there has to be more involvement by a board member or an outside, maybe even an outside accountant. I've seen in certain instances where a client may only have a one-person accounting department, maybe a two-person accounting department, and because the two people are doing so much in terms of the transactions, they utilize a treasurer of the board who obviously, as the treasurer of the board, has knowledge of the operations of the organization and some of the financial components of the organization. And so they use the treasurer to be their sort of independent eyes in terms of review of things like bank recs and some of the internal processes and procedures. They use them as the third-party signer on certain things, again, in order to mitigate incompatible controls. Sometimes at certain of our clients, they use an outside accountant. That outside accountant may come in once a quarter to look at, again, bank reconciliations, to review certain processes and procedures. And again, that outside accountant functions in a way of independent eyes, sort of a third-party person when there's a small accounting department. So I just think in terms of managing federal awards or any governmental contracts, even private dollar grants, because again, this level of accountability in terms of the internal controls does not just extend to federal awards. Whether you're getting money from the Amundsen Foundation or any other foundation, they expect that their money should be handled in a proper way as well. So the internal control design is not just exclusively to federal awards, it's to any monies that are coming in the organization. And so making sure that your systems are designed in a proper way or in accordance with best practices is really important. The payment or cash management section of Subpart D, again, applies to non-federal entities other than states. It talks about the fact that you must minimize the time between the transfer of funds. And again, I won't spend a lot of time on this because this is an area where people are getting advanced funds. But again, it just means that you must have a written policy on how those advanced funds are then expended within a short period of time to, again, minimize the time lag. Because ideally, if you're holding on to federal funds, you're for extended period of time, you're earning interest income. The contract award frowns on that because ideally, if you weren't intending to spend the funds in a short time frame, then they shouldn't have been drawn down from the Fed for use. And so it's really important. This is a significant finding under a lot of under a lot of awards where there's advanced funds. But for most of you, again, they're on the bottom bullet. If the above requirements are not being done, most of you are in a reimbursement method under your contracts. Cost sharing and matching. For some of the contracts that you have, there are some matching requirements, and some of your organizations are meeting that match requirement with cash and or in-kind materials and or services received from third parties. Note that if you are receiving the in-kind, certain things must be documented in order for that match to be valid. And so here it talks about if you're going to do it for cost sharing or matching, there must be verifiable records to support the in-kind that you're counting as match. Again, for most of you, this is being documented by invoices received from the people providing the services, or sometimes the people providing the materials. In an example, if you were a children's organization and you had a donation of toys, perhaps for Christmas, and it was from Disney. Disney would send the invoice that told you what the market value was for those things. In other cases, if you're receiving in-kind legal, or you're receiving perhaps some type of donated time from professionals that are related to programs, oftentimes you can get the information from that professional that talks about the value of the services received, what they would charge paying customers for that same work. In terms of other donated materials, things like clothes, perhaps toys, and things not necessarily from large corporations, I've seen where clients have developed sort of a price sheet for things for sort of secondhand items that they use to then document, we received these 3 sweaters that we used for the children. They place a value, and that value comes from a pre-established price sheet prior to receiving those items. So that's really important, that you just have a mechanism, a predetermined mechanism for valuing. And you want to make sure that anybody who's involved in the receipt of those in-kind services and or materials is aware of what they need to do to document that information, so that that information is accurately getting into your accounting system, and that you're not having to do sort of an after the fact obtaining of the information. And again, it talks about that there must be verifiable records. You must make sure that that in-kind is not a match for another federal award, that it's necessary and allowable with respect to the program. That bullet is just basically stating that perhaps I received, let's say, in-kind food, and I'm just using this as a broad example, but perhaps I received donated food. Well, if donated food is not specific to that program, this is a program that would have no reason to be receiving donated food, then I shouldn't be considering that as a match for that program, because it really has nothing to do with the operation of that program. And so again, I'm just using that as an example, but you want to make sure that, again, whatever the in-kind that's being counted for cost sharing or match, it has to be, again, consistent and necessary and allowable with regard to the particular program. And then again, that it's not paid for by any other federal award unless that's allowed under an authorized statute. Again, in the new thing that's really been made clear here is unrecovered indirect costs may be included as part of cost sharing with prior approval. So what this means is unfunded costs that are in the program may be able to be counted as a match or cost sharing, because again, no other federal source is paying or is utilizing those dollars, and ideally those costs are probably being covered, but by non-governmental money. So particularly, the example is you have a program, and perhaps you're spending $100,000 in that program. Well, the government money that you're getting is maybe covering $80,000 of the program expenditure. So there's $20,000 that's unrecovered or unfunded. You may be then, if you were required under that program to have a match, you may say, well, the unfunded or unrecovered costs there may be used to meet your cost sharing or matching requirement. And oftentimes the unrecovered indirect relate to, let's say you have an indirect rate that's 15%, and that particular contract only pays for 10%. Well, you've got 5% of unrecovered indirect costs. You may utilize that 5% as a match, because in effect that's a true expenditure that you've incurred on behalf of the program. It just was not funded or covered by the program award. So those are cases where there can be unrecovered indirect or direct costs that can be used as match. But again, in most cases, the sort of unrecovered indirect you have to make that clear on the front end with the awarding agency. Program income, for some of you, you earn program income. In most of the cases, your program income is being done to, as noted here in the first bullet, defray the cost of the program. In some cases, based on the program award, it has to be placed into reserve. In some cases, it may have to be returned to the federal agency. Again, if it's not indicated specifically in the award agreement, typically it's an offset to the cost. It's that bullet number 1. That's most of the time it's how it's used. And then, just to be clear, proceeds from the sale of equipment that might have been being used for the program is not considered program income. Program income typically are things like client fees, being paid by the by the client you're serving related to that program, that's typically program income. It's income generated by the program, but not being received directly from the federal awarding agency. Procurement relates to, and this is an area that's been expanded now. I would encourage everyone to really focus on this area. There's now sort of these the five following procurement areas, and there's certain there's methods that must be done in each of these areas. So there's now a definition of what's considered micro purchases and the systems and processes that have to be put in place related to those. There's definitions about what are considered small purchases. There's definitions about times where when you're procuring certain items, you have to then do sealed bids, and there's a threshold related to that. There's the same for competitive bids when those have to be obtained. And then there's also now guidance on what we call non-competitive bids, where you may only be using a sole source vendor, and what the documentation has to be as to the reason why you're using a sole source vendor. Really, under the new uniform guidance, there's really some encouragement about seeking the use of several vendors over the course of many years, meaning if I've been using this particular vendor for 3 years and they were the competitive one at the time when I went out, I got 3 competitive bids and they were the vendor that came in the lowest. Well, then maybe the next year I go out and I do another competitive, or maybe a couple of years I do another competitive bid analysis, and they're not the lowest anymore. That it's really trying to encourage the use of multiple vendors, because they're concerned about when an organization is using a certain vendor for 20 years, does that lend itself more to certain kickbacks being obtained and things like that. So again, there's very specific guidance in this area now about the requirements that have to be documented, the processes that must be followed in this area of procurement. And because this has now been expanded over what was originally there in the old circular guidance, I encourage everyone to really take a look at this area. Again, under the procurement area, it talks about the simplified acquisition threshold of $150,000 must be considered. And then in general, the uniform guidance is adopting what was in A102. Because we were using A110 as nonprofits, there are some things that previously you weren't subject to under A110 that was in A102 that's been incorporated in this procurement section of the uniform guidance. So again, I encourage everybody to read it. And then this has to be incorporated into your processes and procedures as a nonprofit. So here on the next slide, it's talking about for compliance with the new procurement standards only. If you remember in my original slide when we first started the session, I talked about the administrative requirements had to be in effect right after 12/26/14. Because this particular procurement requirement is more of an agency-wide implementation that has to be put in, the government is recognizing that even though the uniform guidance went into effect on 12/26, which was the middle of the year or the end of the year for some of the organizations, that there was no time given for organizations to really ramp up and put this into effect. So 1 year, so the federal government is providing a grace period, a full 1 year grace period after the effective date to get this into compliance. So again, for those of you who, if this went into, the requirement went into effect at 12/26/14, they would give you 1 full fiscal year, which would be 12/26/15. So for those whose fiscal year ends are 12/31/15, this should be in effect. And then for the clients that are the 6/30/16 year ends, this should be in effect. So, and again, I want to make clear that the procurement relates specifically to cost charge directly to items procured that are charged directly to a federal award. The one caveat here on the bottom is it talks about that it's not applicable to costs that are charged through indirect, but they must be charged directly. What I would say is that you probably don't want to get into a place where you're having one set of rules for procurement related to federal awards and one set of rules to things that are procured and maybe go into an indirect cost pool. This typically is going to be an agency-wide policy. So 9 times out of 10, whatever the standards are that are set for an overarching agency policy are going to be applicable to those things that are in your indirect pools and in your direct pools. So I just caution everyone to think about that when they're designing these policies as they relate to procurement for your overall agency. Award monitoring and reporting, again, this just talks about that your organizations are responsible for monitoring your programs on a consistent basis to make sure that you're in compliance, that you have to submit the interim reports as often as they are required, but no less than annually. Under certain contracts, they may be required quarterly. And if there's performance reports, things related to how many clients have been seen or meeting certain milestones, that again, those need to be turned in on a regular basis as well in accordance with the award agreements. And again, if there are adverse things that go on in your organization that might impact your performance related to an award, this is being made very clear in the uniform guidance that you need to notify the awarding agency on the front end. As soon as you see that something is going on, perhaps there's been 2 key people who left in the program and it's going to impact you making certain milestones or meeting certain criteria, then you should notify the federal agency of any significant developments, particularly if they're going to create issues with you meeting certain criteria of the award. Subrecipient monitoring and management, this is an area that is significant. And there's been a lot of more explicit guidance put in the determination of whether somebody is truly your subrecipient or contractor. We do have a handout that was related to that, and I will forward that to all of you at the completion of this. We have the email addresses for all of you at the completion of this presentation that was taken from the uniform guidance, or was derived from the uniform guidance as to when a person is truly a subrecipient and when a person or an organization is a subrecipient versus a contractor. And then the evaluation of the substance of that relationship needs to be done on a case-by-case basis. You may have a contractor that you use under one contract, and under that contract they may be a subrecipient. And then that same person or organization is being utilized under another award, and under that award they're a contractor. So you can't assume just because they perform because they're the same organization that they're both a subrecipient in both situations. It's on a contract by contract basis or an award by award basis that you need to establish that criteria. And you have to document your evaluation process. So this is not something that can be done ad hoc. It needs to be done at the start of the award. And we as the auditors are required to come in and know that you are doing this evaluation. So if we come in, because again, there's certain criteria related now to subrecipient monitoring. So you first have to decide and develop a process for who is a subrecipient and who is a contractor. And then once you identify who the subrecipients are, there's going to be very specific monitoring and procedural rules that you're going to have to follow in regard to monitoring the subrecipient. So this needs to be documented, and it needs to be an evaluation process for each award. And you should establish the policy and procedure for this type of evaluation, again, at the onset of the award. And again, for any subrecipients that you are utilizing, you must include certain things in their award agreement, which includes the CFDA number, the program description, indirect costs. You have to denote what will be allowed and what the percentages of allowability of indirect costs. For some of you that are claiming the de minimis 10%, you may be passing on that same claiming of de minimis 10% to some of the subrecipients. All of that has to be specified, or if there's going to be a cap or a maximum on indirect cost, that has to be identified in the award. And if there's obviously if there's federal award amounts in that, you have to identify how much the federal percentage of that contract or subcontract is as well. I talked about this earlier, that you now will have to do a subrecipient risk assessment of noncompliance annually, meaning, one, you have to assess them on the front end of whether you should even be involved with awarding them pass-through dollars. But the other thing is, on an annual basis, you have to then analyze whether or assess whether you should continue to utilize them. And that consideration should be based on previous experience. It should be based on whether they've had prior audits and whether their audits have had certain findings related to the program, whether they've got new personnel or changes in their systems that might impact the program, whether there's even been federal agency oversight from an outside agency that came to audit them, which might have included your program, and there were issues. So all of these have to be considered in whether you should continue to pass through dollars. What now has been made very clear is it's not an automatic that you re-up and utilize maybe a particular contractor, or I should say a particular subrecipient or subrecipient organization year over year. You're going to have to document why you should continue to be able to use them, and a lot of it is going to be addressed by addressing these certain things in an assessment. And you're going to need need documentation of that assessment and need consistency of that evaluation across all programs. So what that means is I don't do one type of assessment for HUD, for subrecipients under my HUD program, and then do a different assessment for people under my Department of Education program. Particularly for all of the federal contracts that you have, and particularly those where you have subrecipients, there needs to be sort of a standardized process for evaluating subrecipients and whether they're adhering to and complying to all of the regulations under the main award, which is your federal award, but also your sub-award with them. And this evaluation and determination should translate into the frequency and depth of monitoring. So if I have a subrecipient that I do the monitoring, that I evaluate them, and I say, my gosh, they've had findings, they've been by their own audit, I see that they've been misusing the funds, that they've been charging unallowable costs, that then should then be evaluated to say, I now need to go visit them once a quarter, or I now need to get more information from them related to my award. So if you do the risk assessment and the risk assessment proves sort of adverse, you then have to then document what you're going to do then to monitor that particular organization. And it may not be the same across all. Some organizations may in your risk assessment may be perfectly fine, and you're just documenting that you'll only get information from them annually. And then there may be other organizations who in your risk assessment don't come out with such flying colors, and then you're going to have to say, well, then that means I have to increase the frequency and the depth of what I do to monitor that organization. Subrecipient monitoring procedures here are listed. They can be in the format of desk reviews of submitted reports, and I would caution anyone that desk reviews just means if I'm getting say I'm getting interim bills from the subrecipient that is their bills for reimbursement, and they put behind there maybe payroll registers and some of the supporting documentation. That's a desk review. I would caution that probably should be used in more cases where the client in your risk assessment is doing fairly well. If the client is not doing fairly well and you want to do more in depth, then you have things like on-site reviews, going to actually visit their premises to do observations of the programs. AUP is an agreed upon procedure. You may hire a third party to do a specific monitoring of them in the areas of eligibility, allowability, their cost allocations, and their reporting. And then also obtaining their audit reports is another way of monitoring the organization. And so, again, your determination of what level of monitoring has to be used is going to be directly connected to your risk assessment of that client. And sometimes as part of your subrecipient monitoring, you have to use evaluation tools, which could be certain checklists that you've developed. And you may have to then go out and do on-site training to make sure they understand what's required of them. And again, agreed upon procedures may have to be performed by independent firms. Our firm does that for several clients that are not necessarily audit clients, but they hire us to do agreed upon procedure audits of their subrecipients. And again, when you do find issues, you have to think about what are going to be some of the remedies. It may be that you impose additional requirements on them in terms of the frequency of how often they report to you. You could withhold cash payments. You may disallow certain costs and not pay them for certain things that you feel were either unnecessary or non-supported. You may initiate suspension or debarment. You may withhold further awards from them, or you may have to seek other legal remedies. And then the closeout for all federal awards, again, the uniform guidance is being pretty clear that under these federal awards, the closeout process needs to occur no later than 1 year after receipt of all the final reports. So I think they're really trying to tighten up the length of time it takes to close out some of these federal awards. Personnel costs in Subpart E. Subpart E is under the cost principles. The one key area related to personnel costs is I talked about that there were going to be some changes in the documenting of the existence of employees, the reasonableness of compensation, and the allocation to federal awards. There's been some expansion in that area, specifically to personnel costs. So again, I would encourage everybody to really hone in and read that. And then the biggest area is there's been changes primarily in the allocation of salaries to federal awards and how that is being documented. As it relates to this area, again, they did that in an effort to create less administrative burden on documenting time and effort. And there's going to be more effort placed on making sure that you just have good controls. So as long as we can document that there's sufficient controls in place and there doesn't seem to be any vulnerability in the controls, then the federal agency will have the ability to say that they might accept alternative methods to documenting time and effort. And so from, like I said, the guidance on this part was not very, very succinct and very clear, but it sounds like back when I first started, people were able to use time studies and as an alternative method to just maintaining a week, every 2-week timesheet. So those types of things may sort of come back into acceptance again, but it's going to be contingent on the establishment of the fact that there's good controls and that there's a documentation of when that time study is done, how frequently that time study is done. All of that is going to be predicated again on the establishment of good procedure and process on the front end in order for a federal agency to accept this sort of alternative method. And so again, I'll emphasize that that alternative method has to be agreed upon in advance by the federal awarding agency or even the pass-through agency. And again, that budget alone cannot be the basis for the allocation of time, because ideally budgets may lend themselves to this particular award gives me more money, so I'm gonna budget based on the budget they give me more money, so I'm gonna give them more of the time. It can't be based on a budget. It has to be based on a reasonable methodology. And again, the design of that methodology, I think, is being loosened away from just it being timesheets, which sometimes can create an administrative burden. In the interest of time, because I know we don't have a lot of time left, and I want to make sure that I get to the end to talk about a couple of things as it relates to the financials and to nonprofit viability. I'm going to go through some of these last couple slides as it relates to the uniform guidance fairly quickly. Again, if anybody has any specific questions or anything that they felt like I might have overlooked or they wanted expansion on, please feel free to email me and or give me a call here at the office. But again, this about the compensation, again, is just echoing that some entities will be allowed to replace detailed time and efforts reporting with some more performance-based reporting. But again, it's going to require agency approval in advance. And the system will need to have a good basis for establishing the estimates that the time is based on. So again, if it's a time study, the frequency of how often you're doing it, and there needs to be still some sort of reconciliation that total time is being captured. And then what percentage of that total time is federal. Indirect cost, here is where there's the conversation about, again, negotiating a federal indirect cost rate. I spoke about this a little earlier, so I won't spend a lot of time here, that pretty much between either getting an indirect cost rate from the organization that gives you the most money or just utilizing a 10% de minimis of the modified total direct cost is what's pretty much going to be out there for organizations in terms of their indirect cost reimbursement. And the one thing I'll caveat is that with the federal indirect cost rate, there now is going to be a one-time option to extend your rate for 4 years. So under some of the indirect cost rate proposals, people were having to re-up and apply every year. Once you get the rate established, there's going to be the ability to just extend that rate for 4 years. So in effect, you would have your initial year rate plus an extension of 4 years, which means you could use that same rate for 5 years without having to then formally do another cost rate proposal until the end of that 5th year period. I talked about the thresholds raising. I also spoke about that there's certain things in the, this is actually new, I spoke about there's certain things from the auditor standpoint that have changed about our assessment of major programs and high and low risk items. This is very specific to us as the auditor, so I won't spend a lot of time, but I wanted to make you aware of it. Again, if you read the audit requirements section of the guidance, you will see that this is laid out. But the biggest thing that we now have to consider as part of the federal award analysis is going concern. As auditors, we were always required to consider going concern from a financial statement level, but now we have to consider going concern as it relates to your federal awards. And so again, this is talking about whether you can be considered a low-risk auditee and the percentage of coverage that we have to do when auditing compliance if there's going concern type issues. So again, this is something more on our side, but I just wanted to make you aware of it. The other thing that will also is also critical is that there's expanded finding requirements. So when we do have findings, there's going to have to be more detail put into the findings. There's going to have to be the view of the officials of the organization has to be included. So a management response must be included. We have to indicate the number of years the finding has been repeated, and then the client must address why it is not resolved. So again, if it's occurring year over year, you have to address why it hasn't. The client has to address why it hasn't been resolved. And then in prior times, you were only really required to address federal findings under federal programs. If our audit notes financial statement findings as well, the client, you as the organization, will now have to, your corrective action plan will now have to address the financial statement findings as well as the federal findings. In times past, most of the officials were only concerned with the findings that related to the federal programs. Now there's also going to be concern over things that relate to your financial statements as well. And typically financial statement findings relate to things that are related to processes and procedures that may not directly relate to a federal program. They may be things like the frequency of how often the bank accounts are reconciled. That doesn't relate directly to a federal program, but it can relate to financial statement information and the accuracy of information in the financial statement. So we could be making a bank reconciliation finding, and you will now be required to follow to have a corrective action plan related to the financial statement findings as well as the federal findings. So just to revisit, and I hope everyone can see this as well as they can on their screen, but we're entering into the last couple, we just have a couple slides left, so we may go about 5 minutes or 10 minutes over, and I'm hoping everyone can stay with me. But we talked in a previous seminar, a previous symposium that the firm had, we talked about the fact that the Accounting Standards Board and the AICPA is looking into changing the reporting model for nonprofit financials. And so what's been talked about is sort of this two-column approach to reporting the statement of activities. And so right now you have a three-column approach which reports unrestricted, temporarily restricted, and permanently restricted if it's applicable to your organization. Now they're proposing sort of this two-column format which just says without donor restriction and with donor restriction. So really, realistically, temporarily and permanently, if you have that, are sort of being collapsed into this one common column. So that's one thing that's being proposed. But what more importantly is being proposed is really what's happening over here on the left side of the screen, which is a breakdown into a sort of operational and non-operational section of the statement of activities. For some of you that are out there that have either investment portfolios, you may even have cash accounts that you set up as cash reserve accounts. So maybe you don't have a formal investment portfolio, but you might have a CD, you might have a cash account or a savings or a money market account that you consider to be sort of a cash reserve account. That's going to be important in sort of this sort of the presentation. What this now is doing is typical to the financials we produce for you now. This is sort of an abbreviated statement of activities, but you can see on this first line here we have program service fees, bequests if you receive them. This could also be private donations, and then other contributions. So this is typical, this is standard how this would be presented, and so you can see total revenue and support for the year is $28.95. But you've also got some support that was received. You see we're going to call that $1.5 million because these are in the thousands, of other contributions that were received with restrictions. and then some that were released in the year. So your total revenue for the year is this $3,020,000. Then we've got the expenses collapsed, right? Not right now, broken down into program, fundraising, or management in general, but your total expenses for the year were $1,950,000. So from an excess revenue or deficit for the year, you had $1,070,000 at this point from of net revenue. Let's just say 125,000 of it came was net with the donor restrictions, meaning you had this $1.5 million that was received with restriction. You appropriated or spent 1,375 for its purpose, so you've got this 125 that's sort of left over with donor restriction as net for the year. On this column, you've got the 2,895 that you received in revenue, the 1,950 in expenses, and you've got sort of this 945 as excess revenue. Well, that would be the stopping point as it relates to most financial statements. And in most cases, this investment return down here would be up above here as part of sort of your other revenue. And so what this new presentation format is trying to get at is, one, putting investment revenue below the line, because you don't typically, with changes in the market, mostly unrealized gains and things of that nature, you don't really get to dictate what goes on in the market. So it's not really seen as an operating type of revenue. But for some of your organizations, you do appropriate a portion of investment earnings to be part of the operating budget. So let's say your investment portfolio for the year earned $500,000 in actual interest and dividends. Some of your organizations may appropriate $200,000 of that interest income to be used for the operating budget each year as sort of a subsidy for your government contracts. So in this particular example, that's what's being considered in this sort of presentation, I should say. So in this particular example, you can see here that the investment return is down here. Now, I'll caveat that by saying investment returns are comprised of several things. It can be the interest and dividends, but it can also be unrealized and realized gains and losses. So it just depends on your organization whether you appropriate such things. Most of the time, the gains and losses, because those go up and down, you don't necessarily appropriate those because that's not true cash. But in this particular instance, you can see there was $170,000 earned on the unrestricted column in the portfolio. Well, this organization took $90,000, you can see here tagged as B, and appropriated that investment return to be part of its operational budget. So the 90 down here is shown as a negative, but you can see it returns up above in a subsection called Board Appropriation and Transfers to and from Operations. So the 90 leaves this sort of non-operating section and re-shows itself above in the operating section. So this again would be the same for the amount that you typically appropriate from a budget standpoint to be withdrawn from your investment portfolio and utilized for operations. And then the same thing has gone on over here in the restricted column. Some of you have, let's say, an endowment, and the endowment corpus is restricted, but you have certain earnings that are available to be used for operations. This particular presentation is showing that. There is $60,000 you can see on the screen earmarked as A that was earnings that might have been unrestricted that's now leaving this restricted column because this is related to the endowment, but it's making its way back in the unrestricted column as investment returns appropriated from the endowment. So it's making its way up into this operating section to show the donor, or I'm sorry, to show the reader of your financial statements a better presentation of your operating results. So the only one other item here that also is being transferred is, if you look here at the top, I talked about the fact that there were bequests of $600,000. Some of our clients move their bequests into their endowment. That is their policy. They say, we don't want to use bequests actively for operating activity. We want to take those bequests and build an endowment. So in this particular case for this year, $600,000 in bequests were received. Well, you can see here in this operating section, it says bequests transferred to the board quasi-endowment. $500,000 of those bequests were transferred from the operating section to down below to the non-operating, meaning only $100,000 was earmarked to be used for current budgetary, for current operational needs. So that 500 was moved from the operating section down to sort of the non-operating section. So the important part about this, after all these transfers, is we now have this new subsection titled Excess Deficit from Operations. And so what this is telling the reader is, yes, I have made, if you look at the bottom, under the current presentation of the financials we have right now that we issue to you, all the donor would see is that your total change in net asset or income for the year was 1.685, here where I'm pointing out to the right. What this is now letting the reader know is, yes, it was 1.685, but operationally the income was just 720, because this is what we really consider deemed as used and earmarked for operations, is this $720,000. The remaining $615 from investments, that could be unrealized gains and losses, which technically doesn't have an impact on operations. And then again, there's also this $500,000, this net 350, that was appropriated out of operations and transferred for non-operating purposes. So you've got those sort of three things adding up together to make your change in net asset. Now, there's been a lot of proponents of this presentation because people think it will give the reader a better understanding of what they're doing operationally versus non-operationally, as opposed to just seeing we have $1.6 million in net income for the year. The reader will be able to better tell what's really going on, and your board will be able to better match that up with your operational budget that you use internally for your organizations. I have that comment a lot when I come to present at board meetings, and I tell the board, oh, you've made $1.6 million for the year. And then a board member will raise their hand and say, well, that's funny, because I remember when we did our budget, operational budget for this year, we didn't budget to make that much. Why are we so far off? And sometimes it has to do with portfolio gains. Sometimes it has to do with these one-time bequests that you've received that weren't in the operating budget. So a lot of being able to sort of layer it in this format will give the board and some of your outside readers a better way to match up operational budgets versus your actual agency performance in your financials. Right now, your financials currently don't have that sort of layout, and so people are proposing this sort of format to better sort of align with their internal reporting mechanisms. The only other couple things that are still out there that are also being proposed is the statement of functional expenses. You can see that there's the typical columns, Program 1, Program 2, General Administrative Fund Development. But over two columns over, there's sort of this non-operating column. There's been some discussion about having a column for non-operating expenses and then not having to break those down by function. So having to not take your non-operating expenses and break them into program, G&A, and fundraising. Right now, I can't truly see the value just yet in this, but obviously it would eliminate some burden on having to allocate non-operating costs into function. But the definition of those non-operating costs, I think, would have to be clearly defined so that it's not distorting your functional allocation of fundraising, G&A, and program expenses. And because those numbers are paid so closely attention by outside readers of your financial statements, and they look at those metrics and ratios, we just want to make sure that not too much is being lumped over into non-operating. I think currently what's being considered over there would be like investment advisory fees, certain other fees that you pay that really have nothing to do with day-to-day operations. And then the last thing that's being proposed is going back to the direct method of the cash flow. Right now, most of the cash flows that we're producing in the financial statements that you receive is the indirect method, which sometimes for readers is very hard to comprehend the impact of cash and how it's moving through an organization. So this is returning to what we call a direct method. And you can see here that it's basically cash received from service recipients. So that would be the cash coming in from your from the performance of your services, cash received from donors, cash paid to employees, cash paid to vendors, purchase of property and equipment. So it's now going to more of a cash in, cash out presentation, as opposed to the current financials that we produce are more on a change in the balance sheet, a change in accounts receivable, a change in accounts payable. It's doing it from what we call an indirect method. And so for some people that sort of aren't the astute accountants, it's harder to see really the impact of the movement of cash from the organization. And then a couple other things that are being proposed is to obviously move purchase of property and equipment and contributions related to property and equipment up in the operating section, where these traditionally had been in the investing section. Interest and dividends earned had previously been in the operating section. And you can see by my blue arrow that that's being proposed to be moved from the operating section to the investing section. And then interest paid on long-term debt, which used to just be actually a disclosure on the bottom, is actually going to be included in, from the standpoint of the direct method, would be included in the financing section. So these are just some of the things that are coming down the pike with regard to the financial statements. And I just want to keep introducing that and encouraging everybody to think about how this maybe change in presentation might be beneficial to your organization. And like I said, if you're clients that have reserves and have earmarked accounts, even on the statement of activities, if you're setting aside cash for a board designated future reason, you could also use that operating and non-operating sections to also earmark those types of transfers. So I just want to encourage everybody to think about how that might be a beneficial presentation. Right now, this type of presentation is still in comment period in terms of the regulators, but it's something that definitely seems to be pushing forward. So I'd imagine it might come into view, and maybe it might be put out there as a potential way of using it in 2016, and then probably then introduced in maybe like 2017. So I just want to put that in the forefront of people's minds. And then the last couple slides relate to and focus on financial viability. There's been a lot of discussion within the new uniform guidance about evaluating financial health of organizations before the state or the federal government offices issue awards to you as nonprofits, and then you as nonprofits evaluating the financial viability of even your subrecipients. And I think this is going to be seen more not just in the government environment, but also in the private foundation environment or private fund givers. I see that they're going to start looking more at financial health, because there has been some organizations that have gone out of business and that have shut their doors, and I think there's just going to be more attention paid to the sustainability model of certain organizations, and whether the funders want to give dollars to those organizations that don't look like they're sustainable. So funders both in the public and private sector are placing more focus on financial viability, meaning the health and sustainability of your organizations. You are specifically required to assess financial viability under the federal awards now, both as a pass-through organization from the state to you, and then from you to your subawardees. And you must develop a specific mechanism for this evaluation at least annually. And so what I have put here is that I think that if you as nonprofits evaluate your own financial viability, that in keeping in line and in looking at on a consistent basis, you'll know ahead of time how you fare and whether you would be the type of organization that a government funding office would continue to give dollars to, and or a private foundation give dollars to. And so what I've put here is that NPOs need to evaluate their own viability by considering the following: evaluating their working capital needs, both short-term and long-term, because again, that can have a potential impact on your sustainability. Looking at the subsidies that you need, either the subsidy required or the surplus generated from your programs. This is actually a really important bullet about looking at what programs are not being covered by the funding. What programs need private dollar subsidies? What programs are generating a surplus? That's an important evaluation in a nonprofit. It also helps you steer where you may need the money. If certain programs are not generating a surplus and they need subsidy, that will help you define where you should ask for dollars and how you'll be able to sort of fill that gap. Exploring other revenue opportunities. In this day and age, many nonprofits are looking into other revenue sources to subsidize existing programs. You have people getting into social enterprises which generate money. You have people considering UBIT related activity, and UBIT is not a bad word. You just have to control how much of it that you do in terms of having unrelated business income. But for some nonprofits, you do pay the tax and you still have a surplus left from that operating activity. So certain nonprofits are considering that. I have a couple that have entered into social enterprises, and they haven't been subject to UBIT because they're actually using clients in those social enterprises. So it's a form of job development or job training, and so it meets the definitions of their mission, but it's also generating income for the organization. They've started a cleaning business, and they've used some of, in this particular, it's veterans, but they've started a cleaning business with the use of the veterans. It gives them job training and employment, but they're also generating income from the cleaning service. So just looking at other opportunities out of the sort of the traditional models to see if you can generate income for future sustainability. Evaluating the return on your fundraising. If you're spending $200,000 to only raise $100,000, then it's working in the wrong direction. You often need your fundraising dollars to subsidize your programs, so it's really important that you look at the return on your investment, your ability to continue to fundraise in the future. Do you have to change the face of your fundraising in terms of maybe in the past you did a lot of galas and those seem to not be as lucrative as they once were, and so maybe you have to change the mechanism for how you do fundraise. I think that's important, and again, I think in looking at the long-term return on the fundraising investment. And then the last bullet, which is really important, is evaluating the demand for your services and the future impact of social change on those services. And I liken this to many of our not-for-profits that were in foster care. Foster care programs, in terms of particularly residential programs, were sort of the cornerstone of how a lot of the nonprofits that we work with were established. Well, over time, census dropped. Obviously, funding was very strained in the earlier years, and many of the earlier years, and so it became a program that became very hard to sustain for many of the clients. And then what also happens is that the focus of society started to be on maybe getting services to a family before a child got into out-of-home placement. So you have to always constantly be looking at what's going on in society and how that may impact the direction of the organization or the direction of the programs. And being in front of that may allow you to make changes that, again, impact your sustainability going forward. So I think it's important to look at that, always look at what will be the demand for our services in the future and what's the potential shift in social change that might impact the services you provide. And then I think to also the necessary tools for analyzing your viability and sustainability include having long-term strategic plans, looking at multi-year financial review, and I would say review in arrears, meaning looking at your last 5 years maybe and looking at your 5 years going forward in terms of projections. I think looking at metrics in terms of your working capital, in terms of your cost to raise a dollar, looking at historically where those metrics have been for you, and then making certain determinations about what you want those metrics to become or where you would like to head in a certain direction in terms of those metrics will be important. So multi-year financial review, both historically and then creating certain projections going forward. I think continually looking at your cost allocation plans, because those are so critical to how you earn your funds. I think it's important that you continually revisit those as you add programs, as you remove programs, as you add departments. I think it's important because, again, those directly relate to allocation of dollars and then directly impact your cost reimbursement contracts. I think having a robust financial tracking system is important. I think having the systems to be able to track all of the things that you need to do with a lot of your contracts is important. Being able to slice and dice your cost centers to get critical information is going to be important. And last but not least is succession planning. And I say that because we've seen a lot of organizations where the legacy ED retired, and that had a significant impact on the sustainability of the organization. Or a legacy CFO that had a lot of historical legacy data about the organization, and then when that person retired, there wasn't a lot of succession planning thought about in those critical management positions, and it had an impact on the sustainability of the organization. So I think that this area is going to continue to become more and more important, and so I think the more that organizations get in front of their analyzing and looking at their financial health and their sustainability, it's going to be really important, and it's going to keep your organization in the forefront of those organizations that continue to get more funding, whether it be private or public, because sort of cleaning and analyzing and looking at your own house and making sure that it's in the best shape that it can be is going to make people want to look at you as the organization that they want to give money to. So that is the end of my presentation. I apologize. This was a lot of information to cover, and I apologize for going over. But again, if anyone has any questions, certainly feel free to give me a call. My number is on the screen. My email is on the screen. I'd be more than happy to talk to anyone sort of offline about any of the things that I've covered. And as part of our webinar, we also send a short survey about the webinar experience, and so I hope that many of you will take the time to complete it. And then we've also recorded the seminar, so if there's anybody else within your organization that you think might benefit from this webcast, it will be up on our website shortly, and then they can also listen to it as a rebroadcast. So I thank you all so much for participating in this morning's webinar. I hope it was helpful. Again, I know it was a lot of information to be covered, but again, I think it's important to stay abreast of the things that are coming ahead and to make sure that in terms of processes and procedures that your organization are in compliance. So thank you very much, and I encourage any of you also to go on our website, and if there are future topics that you would like covered, please feel free to go to our website, and we have a place where you can make suggestions about future topics. Thank you so much. Enjoy the rest of your morning.